Okay. Now can you see?
Yes.
Yes.
Okay, great. All right, we're back to normal. Okay, so let's look at our calendar. Today we had retail sales. Like every day this week, we had some kind of information that told us something about the inflation, the economy. Today we had retail sales, and it fell 1%, and it's been going down for the last 5 months. But it's looking like a disaster. So it looks like people aren't spending as much on big ticket items. I think the banking crisis might have scared some people into making big purchases, and that means the consumer's not spending. And that's why I brought up this, made a little last minute thing about recessions. Right now, what we saw a hint. This is like a hint in this retail sales report today that the consumer isn't doing as good and they're not spending as much. So we could get into a contraction in in the middle months of the year.
There are.
I'm sorry. Do you have something? Do you know anything about that?
No. I just had my. I thought I was muted.
Oh, okay. That's good. All right. So it looks like okay. So we had some good reports from the banks today, and we're going to start the earnings season off today and pretty much go for the next couple weeks, 3 or 4 weeks. No, we're in April here. Okay, so it started today and we're going through April. Big tech stocks, they're reporting towards the end of April, beginning of May. And the important thing for the tech stocks, we know they're going to have 5 or 10% better sales than last time just because of the dollar going down so much. So we have a hint that they have at least a 5% advantage versus last time they reported, and that's good. But we're also facing an economy that's starting to contract. I think Matthew was saying before that you don't, maybe Jake was too, about you don't see the effects of the rate hikes for 6 to 12 months, and we're right now at the 12-month mark, and that rate hikes from last year are starting to hit the economy, and it's starting to affect how much consumers spend. So that just, in that report today for retail sales, it just gave the hint that we're going to have some contraction, and that could last 3 to 6 months. So let me see. All right, so what I did, it seems as though the Fed made a speech recently, and they said we might be going into a slight recession. And for me, a recession is just a period of time when you used to have to realize that stocks are going to kind of drift towards their PEG ratio of 1, the good stocks, and they're not going to be growing. Actually, the earnings, here's some numbers. What happens in a real recession? We haven't had one of these recessions since we started this group here, so I thought it'd be interesting to show what usually happens in a recession. So the first thing is you have earnings declines. We can look at the charts, and we like to see. Let's look at some of our favorite charts here. There. Okay, we like to look at this chart here particularly, just to see the earnings, and what they're projected to be. And the earnings, we're expecting them to be 20 to 25% less. So if we get earnings decline of 10 to 20%, that's average or more. Multiple contraction of 20 to 25%. What that means is if right now Apple growing at 7%. Apple PE equals 20, let's say it's 28. Now, if there's a multiple contraction of 20 to 25%, that means Apple won't be trading at 28 anymore. 28 times. They'll be trading at a PE of 21. Recession. Okay, that's an example of how stock valuations change when the economy is in a recession. So basically, and what I did was I looked at each of the major banks that give estimates for S&P earnings, because the S&P is the most important. This number, this is like the average of everyone. This is a median 220 for the S&P. If you add up all the earnings in the S&P 500 companies, divide by, you just get this 220. And that's basically flat or up maybe less than 1% from last year. So we had 2 negative quarters, the first 2 quarters of this year, and they're saying that these companies are saying, well, we're not going to have this soft landing. This is what everyone's hoping for in the stock market. The stock market's up like 8 to 15% this year on average. And everyone's hoping for this soft landing, which we don't have more quarters that are negative. But it seems like a lot of the big companies that are pretty smart, they're saying that the earnings should be 10% lower. So we'd be contracting 10%. So we just have, for me being a long-term buy and hold person, I see Apple PE at 28 right now. That's a super premium because it's only growing right now at 7%. That's 4 times its growth rate. So in a recession, its PE will be 21. So expect the price of the stock to go down like 25% during a recession. But if we don't have a recession, then you could ignore this. But I'm saying all these things because if the stock that you're following goes down, then you can't freak out and sell, because recessions only happen 1 out of every 8 years. So it's just something you have to put up with if you're a long-term investor. All right, I thought that'd be interesting. So the end of the year numbers for all these companies basically says we have no growth. Everyone has an S&P 4100 price target, which is where we're at right now. So expect a lot of sideways movement in stocks for the rest of the year. That's what I think. I'm buying and holding, so I'm just an observer right now. What I'm going to do is I'm going to look at we haven't looked at the stochastics charts for a while. I thought it'd be important to review this. This is the most important stochastics chart. We're at 89 in stochastics. That means we're pretty much overbought. We're right in the middle of the channel, of an up channel and down channel. So, and we're at a not greed. Everyone's greedy. So we have overbought right in the middle of the channel, and we're greedy, and we're right in the middle of earnings season. So we could go down to here or up to here in this chart very easily with a bad earnings report. So let me see, but we are in this new channel, which is an upward channel, going into an earnings contraction. So my guess is, with the earnings, the tech stocks are going to do good because they're all multinationals and they're supported by the dollar. But as the summer goes, as we progress through the summer, companies going to have a hard time, and we're basically going to start to go sideways, it seems, because of those earnings estimates by the major brokerages. They're basically saying this is as good as it's going to get this year. This level of the S&P, 4,100. That's where we're at right now. that's the estimate for every major brokerage for the rest of the year. And if we go up from this, that could be like a fear of missing out rally, and we're trading more than it's worth. And if it goes down to lower, then it'll become more of a bargain. But we're basically right where the brokerages think we're at a fair value. The Dan Niles thinks the fair value is much lower, like 10 or 20% lower than we're at now. So we'll see who's right. But we can see most of these ETFs are in an upward channel right now. We had this downward channel for a long time for a lot of these, and we started to break out. And we see. Yeah, so we do have a theme where the stocks are starting to break out, but we know the earnings are going to be contracting in the summertime. If we look at the, let's look at our meeting notes. Okay, we know that this month is a traditionally good month, primarily because we have earnings come out in the middle of April, and that usually helps stocks go up. And usually the months we see, and then we get into the summer months where the stock market usually, seasonality-wise, isn't very good. So that's another indication that we'll probably going sideways for a couple months now. And then perhaps towards the end of the year, the effects of the rate hikes might be wearing off. So let's see about that. All right, so let's look at some more stochastics. I'm expecting a lot of the patterns for the ETFs to go towards this kind of a range because of that theory that the earnings aren't going to be growing. According to almost every brokerage, we're going to be earning less in the S&P or flat from last year. So it makes sense that we're just going to be pretty much flat for a lot of things we're watching. You can see a lot, the healthcare and the industrial sector, a lot of these are just going into ranges. And consumer staples, it's in this range. So I'm guessing at least until the end of the year, it's going to be flat to down. So it just makes sense that we have to temper our expectations to assume that we're just still in these channels until we are out of the recession or slowdown in the economy. All right, let's see what else. Financial is the only sector really in the downturn right now. Most every other sector is, you see, real estate is in a downturn too. Energy is like super incredible. It's still going up from past couple years. One important thing to keep in mind, we haven't gone over this in a long time. This is this company, the Cowan Company, makes a graph, and they update it every year for like 50 years. It's basically it shows you the returns of different types of investments over the years, and you can see that the S&P was a good performer for a lot of these years, but there are other sectors that not every sector does well every year. So you can see last year we had cash is the best investment. Did that ever happen? That happened in 2008 only. But we should be looking at this like at the end of every year, just to reposition or just to understand what sectors could be going up next year. So we can see that the sectors that went down last year the most were large cap equity, real estate, small cap equity. Okay. And so the key is to be diversified so in your portfolio so that whenever one sector goes down, then it makes up for it in another sector. Now you can look at that same, I also pulled up a chart for the S&P 500 ETFs, which is what we review every once in a while with the stochastics. You see, here it is. Okay, so last year, the best sector was energy, and the worst one was information technology. So the I think one thing we were talking about last year is a lot of times when we have an underperformer like the technology, it will outperform the next year. And there are a lot of people that actually do the opposite. They follow the momentum. So last year, if tech went up, it went down 32%. Some people would put all their money in energy, and then this year, energy might underperform. So you have to keep in mind that you got to have your portfolio balanced. If you're doing individual stocks, you try to make your sectors balanced out so that at least whenever one sector is going down, the other one is making up for that. And you see. All right, any questions on that? All right. So we'll go over this periodic table of returns in December, whenever we're looking forward to the next year and seeing what sectors to go into the next year. All right. So what were we talking about here? Okay. All right. So we're looking at earnings season. So we're going to have a lot of ups and downs in the earnings season. So you have to keep in mind, what the fair value of a stock is, and if a stock that's a good one goes down a lot, you have to see if it was rational that it went down. The same thing with going up. Okay. So, okay. All right. So we had some estimates like last year, maybe that, the end of the recession could be, in July. But the one thing to remember is Walter Deemer says that stocks start to go up 3 months before the end of a recession. So if you can predict when the end of a recession is, then you can predict when to start aggressively, buying stocks for the next bull market. We don't know that yet, but we saw an indication today with this retail sales that we could have a problem in the economy with consumer spending because consumers are 73% of the total economy. All right, so I think we're done with this screen. Okay, so the important thing for the treasuries are that they're at 399. That's below what the Fed, the current Fed rate is. So it's going to be really hard for the Fed to raise more than 25 basis points at the next meeting, but we're basically near the end of tightening. So that's really good for the growth stocks and getting things back to normal. But for the next 6 months, we're going to be pretty much flat to, we're going to be going in a trading range, it seems, because we're still being affected by interest rates for the end of the year. All right, so we had good earnings from J.P. Morgan and the big banks today, Wells Fargo. We're going to get the big tech stocks coming up in the next couple of weeks. That's going to be really big because they're a big portion of the stock market. Let's see, we still have tax-related selling. People are going to be owing taxes, and they're going to have to sell stocks to make some money for their taxes. So that could make things in the next week or two. No, next week. That could make the next week a little volatile. Let me see. Okay. So stocks are starting to trade above their 200-day moving average. So when we look at the S&P, our charts here, you can see this. We keep track. These are all the moving averages here. We don't show color here, do we? Oh man. Okay. So these lines here, the blue line is the actual S&P. All these other lines are moving averages, and you can see that for most stocks and indexes, we're starting to trade above that moving average, and the more stocks that continue to trade above the moving average, um, that's a definition of momentum, and that is a good indication we're starting this new pattern of higher highs and higher lows. And that becomes more predictable for us if you're a long-term investor. And um, so I guess you can say that every one of these stocks that we're following could end up going in a sideways range for the rest of the market for the rest of the year because of the economy slowing down. But right now we're looking at this uptrend that we'll hope it keeps going up to higher highs, but most of the stocks follow the economy, and the economy seems to be going sideways. So let's look at some more stocks here. Let me see. Okay, so we see a lot of stocks starting to go sideways, but they are actually going up. Amazon, this is amazing. This stock is one of the only big tech stocks that it's still going down, and it's still in a downward channel. I have a hard time. Well, that still might be. It was one of the most overvalued. It had a PE of like 150 last year, and now it has a PE like 45, and it's not growing. That is a high PEG ratio. So maybe that's why it's not recovering as fast as the other stocks. Okay, so I put two channels in for stocks like Apple, because if we are in a sideways range, this is pretty much the top of the range for this year, and this is the bottom. Let's hope it breaks out of here, but most likely with consumers in the retail sales report, they're cutting back on big items. That's what it said today. So big item is an iPhone. So there's a good chance that this could be just in a sideways for the rest of the year. Let me see. You can see AT&T is in a sideways. A lot of the stocks are still in a range bound. And they're probably in this range bound for the rest of the year. Let's see. Colgate. This is a railroad. A lot of the railroads are out of favor now because of the problems that Union Pacific had with its train derailment. And if these railroads get down to a PEG ratio 1, that would be pretty darn good, because the railroads are a monopoly and they're not making any new ones. And it seems like some of the derailment problems are isolated instance for those other railroads. Meta is just amazing right now. It is the best performer in the NASDAQ, one of the best performers. It seems like what was missing last year when we were talking about this stock, they were spending uncontrollably, and they weren't profitable. They spent more than they made, and so the right around here, Mark Zuckerberg had a meeting and said, "We have discipline. We are not going to spend as much anymore. We're going to fire people." And as soon as that started happening, people had conviction that they're going to be profitable again. And they're concentrating on AI now instead of the metaverse, which is kind of weird that their name is Meta, but it seems like they're turning a leaf with that. Let me see.
Really, with the name Meta, you could have any business.
No, I don't know. I think if they could go back and not do the name Meta change, I think they would.
It seemed premature at the time.
Well, Facebook at the time would actually have a bad public rep. So that's one of the reasons why they changed the name, was to deviate away from public scandal related to leaking data, addiction to Facebook and stuff like that.
You're right. That did take people's. They had a big public relations issue, last year, and it was like every day there was bad news. It was PR news. It wasn't earnings news. It was, they left. There was a hack on their whatever, and there was just bad news, but it wasn't affecting the earnings. So they basically now have news stream on their side. You know, I think it's in Michigan or Wisconsin, or they're going to make a rule banning TikTok in the state. So not only there could be a national ban on TikTok, there could be state by state ban. So the news flow is kind of moving towards helping them now. And they basically have the same earnings as before. It's just sentiment has changed in a major way. But I don't know how they're going to get out of, you know, if the metaverse fails and it doesn't turn out to be, if people don't adapt that as a new platform, are they going to change the name to Facebook again? I don't know. Mark Zuckerberg basically said he's turning his focus on AI instead of metaverse right now. So I don't know. It's for me, I've been saying like the whole time that, you know, I believe in the vision of Mark Zuckerberg. I mean, most of his money is in his company. He's not gonna do something that would make it fail. But I think they're going to I think in the end, metaverse could be successful. It'll take a while though, but I think having that option, it's like a lottery ticket for this company. They're successful the way they are, and if they get the metaverse working, that's just having a lottery ticket. All right, so but it's overextended. Almost every one of the tech stocks right now is overbought. It's super overbought. This very well could go back into a pattern, sideways pattern, if they don't report good earnings. So we'll see about that. JP Morgan, they're in an earnings. I think every stock we're following is eventually going to go into that pattern. Microsoft, you can say the same thing they're in this trading range right now. They happen to go up a lot in the past little bit, but Pepsi is pretty much the only stock that we're following that has been in an uptrend for a couple of years, and it can deal with rising inflation by raising their prices, and they have a steady demand, and they have a snacks and soda business, so that's helping them balance out things. I guess maybe people might drink more when there's a recession. I don't know. All right, so again, another sideways. We're at the top of the range for a lot of these stocks, so it looks like we're going to be could be going down next for a lot of the stocks we're following that are at the top of ranges. Starbucks is in an uptrend, and Verizon, this stock can't get out of its own way. It just keeps going down. I think it's they're just losing customers, and T-Mobile's gaining their customers. I think that's the story with this. Hopefully they won't cut their dividend, but if they keep losing customers, they might.
So before you go, so the Coca-Cola Pepsi thing, there's news stories from February this year that Pepsi's going to slow their price increases because they had a lot of prices increases last year. But Coke says they're going to keep doing it, but then maybe they're moderating it. That is reflected in my experience shopping. I was able to finally buy some Coke products last week, 2 weeks ago. I finally had a sale going at this grocery store, so I don't know. We'll see if they can keep their price increases going, or they might diverge between Pepsi and Coke.
Yeah, I think with inflation coming down, I think the one problem could be during a recession, 10 to 20% of all consumer purchases are lost. So I guess is this a mandatory item to buy? I don't know. They've had the power to raise prices all last year and into this year, and they're still doing really good.
Yeah, they raised prices by that article, Coke by 11% last year and Pepsi by 14%.
Wow.
So we'll see if they're able to keep their sales rates up, and if their demand falls off, I think that we'll see how much they actually have like a monopoly and people keep buying the product with higher prices or not.
Let's look at Coca-Cola just for fun. We'll compare it against Pepsi, just because that's a good exercise to do.
Pepsi though is all sorts of other stuff, right? Pepsi.
Yeah, Pepsi has Frito-Lay. They have a huge snack business, the largest snack business in America.
But is Pepsi no longer Yum? I guess it's no longer the fast food.
No. They spun that off, so they don't have Yum anymore.
And who owns? Okay, yeah, it's coffee. There's like Honest Tea is Coke. Yeah, there's water. There's bottled water.
I would think that Monster Energy is like a really good takeover candidate for one of these, because just think you're selling your product for $3 a can. You know, you have like this. Here's Coca-Cola. Let's see, it's basically flat for like how long? It was at the same price. 2020. Okay. So it's basically the same price as it was right before the pandemic. It dropped a lot, right? Okay, right there. All right, so let's compare that against Pepsi. Comparison, Pepsi. What
And Berkshire owns just 9% of Coke.
Oh, really? I didn't know that. Okay,
yeah,
wow.
They've been holding Coke for a long time. It's the fourth largest holding of Berkshire.
Let's look at the statistics of Coke and the statistics of Pepsi. Get Pepsi here. But I think the stock market, let's look at the stock market in general right now. See what's happening. Stock market's going down. I think the retail sales report hinted that we're going into a recession, and then we go into this, everyone's worried of a 10% earnings decline in a recession, 10 to 20%, multiple contraction. That's pretty much why we're going down. And then we're going into earnings season, so we have the uncertainty of what other reports are going to be coming out. So that's what's happening there. Let's look at Coca-Cola versus Pepsi and their statistics, just to see the premium both of them have and are able to trade at. Okay, so we have right. They're both basically the same size company. Market cap is $250 billion, $250 trillion. PEs are almost exactly the same, 24, 25. PEG ratio, 3 times same. They're 3 times their growth rate. That's probably because they're consistent and they're basically, their business model is predictable. So they have a dividend. There's a lot of people that own it for a predictable dividend and a predictable sales. Let's look at their profit margins. This is interesting. Coca-Cola has better profit margins. It's double of what the profit margins for Pepsi is. I didn't know that. I haven't looked at that before. And their return on equity is 53 versus 37. So I guess what you have in Pepsi could be they make a lot of money in their snacks. So if it costs like 10 cents to make a bag of Doritos and they sell it for $5, that probably gives them the edge on return on equity, I would think. Because they both sell for the same price. Their cans, and they probably have the same cost of making their product, sugar and water and whatever else, caffeine.
Can you bring up KDP also?
Oh, sure. What company is that?
Keurig Dr Pepper.
Oh, okay.
They're smaller. They're only 50 billion, I think. That might be interesting. They have not been doing well the last year.
Oh, really? Do you have any insight into that? KDP?
No, I'm not sure, but I know that they own Keurig and they own Dr Pepper, so I don't know what else they do, but they're in the same market, kind of as these two.
So I think Smucker's owns Folgers, so I guess coffee is a natural way for these companies to diversify. I think Pepsi might own.
Yeah,
coffee.
they do like bottled tea and bottled water too. I think are the other places that they. Dasani and Aquafina are the Coke and Pepsi bottled water products.
Oh, okay. Okay, so here's Keurig Dr. Pepper. We'll see statistics.
Yeah, Dr. Pepper bought Green Mountain Coffee Roasters and added the Keurig on their name.
Okay, so we can see this one compared to Coke and Pepsi, its PE is less. It's 20 PE. PEG ratio is 3, around the same. Its profit margin's about the same as Pepsi. The return on equity isn't as good. That's 5.
Yeah, their brand isn't as strong.
Yeah, they can't really charge as much. They can't make they're not as profitable.
Yeah.
So I guess also are they don't have as big of a market too. They're probably American based versus Coke and Pepsi are definitely around the world.
Yeah, that's probably right.
That's interesting. But I guess what we can do is we could do a let's see. We can look at their earnings growth using the E-Trade system. Hold on for a second. I'm getting that working. Taking a while.
Yeah, I don't own any of these three directly, but I guess I own some Coke through my Berkshire shares.
Oh yeah. I think Pepsi is one of my dividend stocks.
Does Pepsi own their bottlers? So Coke has separate bottlers, right?
That's interesting. I think
some of those
Pepsi
are actually treated.
I think Pepsi owns its bottlers. I think there's Coca-Fisma, there's Coca, there's different companies that do the bottle. That's weird that they would separate it like that.
They've done it different ways, like back in the 80s and 90s and stuff. So they owned the bottlers at one point. They spun them out at one point. But originally they didn't own the bottlers. The bottlers for a long time was a separate business. Back in like the early 1900s.
Oh, interesting.
Coke advertised. They sold directly to like soda shops, and so they were selling syrup, and they did the advertising, and they set the price. And so it was an interesting business, because they had like long-term contracts with the syrup sales, and so they were really interested in gross, in total sales, and not as much on the profit side because they didn't make more profit. They couldn't set the price.
Oh.
In terms, they set the Coke set the price. They set like the 5-cent price for decades, but it was sold like out of soda shops. There's a bunch of weird history about Coke. Yeah,
I think they used to have cocaine in their product.
They actually are the importer. They still use the parts of the coca plant in the flavoring. They have a special import allowance. And they get the flavors out, and the rest of the leaf is used for producing medical cocaine.
Wow.
So yes, it's part of that flavor.
Interesting. Okay, so let's look at Coca-Cola earnings versus Keurig Dr. Pepper. They're both growing steadily. Not great. But they are in a straight line up. So for a dividend stock, you would normally own a stock like Coke for a dividend. Everyone classifies it as a dividend. Let's see if it's growing. 2.60 divided by 2.80. That's 7% growth from this year to next year. So 2.80 divided by 3. So it's 7% growth. 3 divided by 3.19. Okay, so 6 or 7% growth. That's why, let me see. So if Coke is growing 6 or 7%, it's 4 times, you divide the PE, 4 PE by 7, and you get this PEG ratio. That's how, so if they're only growing 7, you're getting a small dividend, which is something like annual dividend 3%. So you get like a 10% total return, but it's consistent. That's why you pay a premium. You pay 3 times its growth rate because they're going to consistently earn and grow over time. So, but let's see, let's look at Dr. Pepper, Keurig Dr. Pepper. Let's see if it's growing at all. I bet it's not as consistent. 1.79 divided by 1.92, 7%. 1.92 divided by 2.07, 7%. 2.07 divided 7%. Okay, so 3%. So it looks like they're all growing around 3% and 7%. And oh no, rats. I got a commercial. Can you hear that?
I can't hear anything.
Okay, because I got a commercial in my ear from some of these. Okay.
It's on the websites.
On the websites, yeah. Okay, all right. So we can't use that website anymore. Okay, that was an interesting. Yeah, they all trade around the same valuation. They're all growing at 7 times earnings, but they're trading at a premium. Coke sells for a little bit more because it's more well known. It could charge a little more. Same with Pepsi.
If they're international, maybe they have more growth potential too than some that's American only. Yeah, that's interesting. Okay.
So the other things are Coke's going to have they're going to have 5 or 10% kick in their earnings because of the exchange rate. The dollar is going down, so they're going to earn more on their overseas sales. So we know that's going to help them this earnings session. All right. So let me see. Let's look at some of the other talking points we had here. Oil was up a little bit, 2.5% since last week. I think the OPEC cuts that happened are just people forgot about them already, and it's back to supply and demand again, and trying to figure out if the economy is good or bad. If the economy is bad, like that retail sales report that happened today says the consumers aren't spending as much, and the global economy goes into recession, the price of the barrel of oil goes down. So we would expect the price of oil to go down today because of that retail sales report. I haven't looked at it yet, but let me see. So inflation, we had a report this week that said it's still going down. So it was 5 point something last time we checked, and now it's 4.98. So for the past 6 months, it's been going down. And I have a little chart here this is from the government. You can see that inflation is going down. And I included this link, which is kind of interesting. Hello. This link is to a website, government website, that allows you to look at a chart and put in different sectors, how the energy costs are going down. And then food at home, you can see that's starting to trend down. The one big thing, if we can get to go down, then inflation will really take a hit. That's shelter. You can see in the government's numbers, shelter is still going up. But if you look at rent.com and a lot of online sources like Zillow, housing is going down in a major way. We said that last week. So that's the one part of the economy that the government has lagging statistics. They're not as accurate as they could be. So, so I left this link in there. You can go and see new vehicles. You can see that their prices are going down. Gasoline is going down a lot. You see. All right. So the banks started earnings season off, and they big banks had good earnings. And it seems like what happened was there was a flight to quality, where a lot of the people that were scared of being in a regional bank, they put their money in the big banks, and that helped the big banks with their earnings. Here's one. What do they call it? A black swan? I don't know, but the government's almost out of cash, and there has to be some kind of action to fund the government. And if that doesn't happen, and if the U.S. defaults on its debt, that'll throw everything out the window, and all stocks will go down. And then on top of all that, we already have the BRIC nations colluding to not use the dollar. And if all that comes together, then I guarantee you the stock market will go down in half or more. It'll be just like a black swan event. So we're keeping our eyes open on that. Let's hope that the government is smart enough to fund the government. Here's a little news article. We know there's some tensions in China about Taiwan and China, and if there's a problem between the United States and China, Apple is going to have a major problem because they do all their manufacturing in China now. But they're starting to diversify into building their phones and other items in India. So they've tripled their output in India, and if they can continue to diversify their manufacturing, then you won't have the problems they had during the COVID times, where their main factory was shut down and they couldn't make as many items. So this could be a helpful, to diversify their manufacturing so that they don't have a problem if we get into some kind of distraction with China. Okay, I was mentioning in this little write-up here how the big banks that predict earnings of the S&P, how they're basically predicting a recession. And Morgan Stanley, this guy Mike Wilson, he's basically saying that the S&P is probably going to fall 20%, and that kind of follows this pattern here, that the multiple contraction in a recession is 20 to 25%. So, and that goes back to our Dan Niles thinks 20% below where we at right now as fair value. So, if you're a long-term investor, you have to know the next 6 to 12 months are going to be sideways to down, and you can't expect too much. And let me see. So I'm ready for a 20% drop in the stock market. And so you have to have that mindset where, there's 1 year out of 10 that might be a recession, and you have 9 out of 10 that are not a recession. So we've had some good times. If you look back into these charts, if you look back at the information technology, the sectors that we're focusing on, they've been doing pretty good, in the last 10 years. And maybe one or two out of 10 years is a negative, like last year and maybe this year. So, so the part of being a grown-up investor is to be able to stomach those bad times, so that you can be in the long term you'll be okay. All right. So Mike Wilson says it'll end the year at 3,900. That's 6% below where we're at right now. And the worst case scenario, he says we'll go down to 3,600. Let's go back real quick to Dan Niles. We've been saying this for a while, and that is right around this Dan Niles single point value for the S&P. So, yeah, an eye on this number. Knowing that, let's say, all these major companies are predicting that there's a contraction by the end of the year, no growth at the end of the year, then there's a very good chance that we could go down to 3,000 in the S&P. We're at like right here, 4,100. So we very well could get down to here. Right. So let me see. Okay. So the other things. Dollar is continuing to go down. Look, it went down another 1% last week. So dollar goes down, gold and commodities go up. That's as long as U.S. Gold is priced in the U.S. dollar. That might change. Let me see. Here's another little view of the S&P earnings estimates from Morgan Stanley. We just talked about that. And we start off the year at 220-ish, and then 195 is like 10% below that, and that's for this year. And then we're supposed to be doing better in 24. So from last year to this year was negative 12, and should be 12% from this year to this year. You see, and this is what I think of a lot. Volatility is the toll we pay to invest. So you have to realize that stocks are going to be dipping 3%. You're going to have a correction of 5% every now and then. Once a year, there's a 10% correction on average. And every 1.5 years, you have a severe correction. And there's a bear market every 3 years. So I think Charlie Munger once said that part of being an adult investor is to be able to buy and hold and kind of ignore all the price movements. All right. I had an interesting article about China and how it does an amazing job at reverse engineering things, and it's basically developed its own domestic airliner to take on the Boeing and Airbus. So last couple of weeks we've been saying there's a duopoly. There's Boeing and Airbus to manufacture large airplanes, but there could be competitor with China, and China might be making competitor to 737. It seems like it's a clone of the 737. So that could hurt Boeing over time. Boeing has they have more demand that they can make right now, but this week Boeing had problems with quality control. Some of the parts weren't so great, so that they still have this quality control problem. So if China can muscle in on their business, they might lose some of their orders. You see. Okay, this guy mentioned here that the stock market has been trading in a sideways range for 10 months now. And he mentioned this range, and I looked at that, and I said, this guy's right. We're at the top of that range now, and we're going into earnings season. So, we do have an uptrend going here, but, we are overbought. We're at the top of the range, and if what he's saying is right, and earnings aren't going to be over the top, and they're going to be flat to down, there's a very good chance that we're going to be flat and following this pattern for the rest of the year. So let me see. Okay, the other thing I wanted to mention, Bill Ackman. He's like one of the true stock pickers that I follow, and he there was a little YouTube video on how he looks at free cash flow, and he says free cash flow is all you should really care about. He looks for high quality businesses and simple, predictable, free cash flow generative, dominant businesses. And he looks for ones that have a moat, and he looks at how much cash flow a company will have over its life. And he basically has enough money where he can take a big portion of a position in a company, and once he has that position, he tries to influence the company to make the changes to solve whatever problem it is that's selling at a deep discount. And it's good we followed some of his picks before. He thinks the assets are worth more than it's trading for, so he'll buy it and then make that known to the public, and then the stock goes up. So we're gonna start following some of the stocks that he follows and see if they actually come true after a while. But he thinks a lot like Warren Buffett. Okay, that's all I had to say for that. All right, I'm getting towards the end of my time. Is there any questions? Anything anyone wanted to go over? All right, that sounds great. Well, I hope you have a good weekend, and if you have any questions during the week, let me know, and I'll research it for next time.
Thank you.
Thank you,
All right.
Greg.
All right.